I got a lot of ground to cover this week. I'm going to start with two speeches by Fed governors, both Trump appointees. We'll start with Stephen Miran. We had this on Monday. Markets absolutely ignored everything he said. He didn't move markets 1 basis point. Other Fed officials, when they speak, they tend to move markets a bit. When I say markets, you see it in TLT, you see it in ZQ. Michelle Bowman was able to move the market a little bit, but nothing on Miran. So let's go through both of them. Again, both Trump appointees, along with Williams, and pretty soon he'll have the chair. And I'm gonna bet he gets cooked, that he gets the ability to fire her and replace her. At that point, you're looking at a 2% nominal rate very quickly after May is over. Okay. This guy here, I view policy as very restrictive. Believe it poses material risks to the Fed's employment mandate and would like to explain why. And his argument is about R-star, particularly the real neutral rate, which he believes should be around 0. And with an inflation target at 2%, he believes the nominal rate should be 2%. Which coincides with a rate Trump has repeated several times. Rates should be 2%. And here he is at 2%. Now, if you read his speech, you'll notice that he cherry picks his data very, very carefully, and his sources that only support his argument. He cherry picks them very, very neatly. R-star reflects the balance of saving and investment in an economy, and it evolves over time with demographics, productivity, fiscal policy, and other factors. I'm not going to argue with that. It is not a one number for all time and forget about it. In my view, it is my view that previously high immigration rates and large fiscally driven decreases in net national savings, what this means is fiscal deficits. And particularly, he's pointing out the Biden administration here. Previously high immigration rates, large fiscally driven decreases in net national savings. Because from 2010 to 2020, it would have been difficult to make his argument that he's attempting to make in this opening paragraph. Both of which raised neutral rates were insufficiently accounted for in previous estimates of neutral rates. Monetary policy was not as tight as many believed. All through the teens, it was basically 0. To say that it was not as tight as many believed, how can you argue that 0 was tight? So he is really, really paying attention to 2020 to 2024 without actually naming it. The same effect may be taking place today, but in the opposite direction. In my view, insufficiently accounting for the strong downward pressure on the neutral rate resulting from changes in border and fiscal policies is leading some to believe policy is less restrictive than it actually is. So his argument is, because you're not accounting for this and a neutral rate closer to 0, real neutral rate closer to 0, policy is actually really restrictive. Notice that he's only bringing two things in, the border policy and fiscal policies. He's not going to talk about AI at all. However, when we get to Bowman's speech, a little head nod to it, a little door opening up and a crack of light coming through with AI on the other side. I'll show you that one. So let's look at what his arguments are. He gives a whole bunch of things. Rents, he talks about rents. The all-tenant inflation, he says, is about 1% based on rent indices, current rent indices. I'm not going to argue with that. I think that is true, and I think that the lag in rents will fall off. Drop in immigration is a big deal for this, and the amount of increased supply in multifamily units over the last year has put significant downward pressure on rents. Population growth. Net migration plus aging population. Looking at population growth of about 0.4%, accounting for the now new low net migration and the aging population. Arguing that this puts downward pressure on the neutral, the real neutral rate by about 0.4%. And he's forecasting 0 net immigration for 2026, 2027. That means people coming into the country will still keep coming into the country because it's not zero immigration, but that they're kicking people out so that the net is zero. Tariffs raising $380 billion a year. That is 1.3% of GDP, which should lower the real neutral rate by about 0.5. That requires a little bit of explanation. This is a tax. He's not saying it directly. He's saying it indirectly. This is a tax on U.S. citizens. And he's talking about it in terms of the national savings rate. It's a tax on U.S. citizens. So what you're doing is you're taking $1.3 billion of GDP out of circulation by taking $380 billion out of the hands of Americans. It is a tax on U.S. companies. And that is how much you're raising at the border. So companies that have shipped their product to the U.S., if they're absorbing some of the tariff, that's fine. That doesn't show up in the 380, only the dollar amount that hits the border. So if you take $380 billion out of consumers' hands, that's $380 billion left to spend. That puts downward inflationary pressure, or downward pressure on inflation. It's disinflationary. Since the government is already running a deficit, and this just makes their deficit smaller, it's not as if they're going to take the 380 and say, well, now let's spend it, new spending. Then that would nullify that. They're just going to reduce the deficit by that. So that is his argument here. The loan guarantees by East Asian countries. This is becoming a stretch here. I'm not quite sure where he's going with this, but he's pulling at every thread he possibly can. If there was an oblique paper written somewhere in a fourth-tier academic journal by a no-name academic, and it makes his case, he's gonna cite it because he didn't bring in any balancing arguments into his speech. Only references that supported his position. That should be down by another 0.2%. I believe the appropriate Fed funds rate is in the mid 2% area. Here he's talking nominal because he's talking about the Fed funds rate. Almost 2 percentage points lower than current policy, 200 basis points lower. And he is giving this speech after the first rate cut. Effective federal funds rate is 4.08% or 4 to 4.25. He's saying should be the mid 2, almost 200 basis points lower. Federal Reserve is being entrusted with the important goal of promoting price stability for the good of all American households and businesses, and I am committed to bringing inflation substantially back to 2%. However, leaving policy restrictive by such a large degree brings significant risks for the Fed's employment mandate. So 4 to 4.25, wants it to bring it to 2.25. This is sort of where Trump is sitting as well. He's mentioned the 2% several times. And look at this. Him and Trump align on their thinking. I wonder how that happened. The text of his speech, because he is I'm going to put it in quotes, a governor. I'm not going to call him that, but I mean, that is the title of the office that he holds. So his speeches are public on the FOMC website. Let's have a look at what Michelle Bowman had to say. And that one I copied into Word so I can highlight it. So let's get that text up here, and we'll just read the highlighted part. Update. In my view, the committee should have begun lowering the policy rate at the July meeting. So, of course, I supported reducing the policy rate at this meeting. For several months, I have been pointing out signs of potential labor market fragility. So has Williams. Increasing signs of weakening labor market conditions provide a basis for beginning to move the policy rate closer to neutral to proactively support the employment side of our mandate. We have a more fragile labor market, along with inflation that, excluding tariffs, has continued to hover not far above our target. Assuming the economy evolves as I expect, last week's action should be the first step to bringing the federal funds rate back to its neutral level. Neutral, I believe the committee has a rate of about 3. That's 100 basis points lower than where we are. That I think we'll probably get there by the end of Powell's term. I think Powell would like to leave office bringing the rate to neutral and then saying, okay, anything from here on that gets messed up, it's up to you guys. But his legacy can be quite intact if he can get that to neutral. Remember that, 100 basis points, because that's important when I talk about ZQ. Economic conditions and outlook. I am more confident that as trade policy has become more certain, not will become, as it has become more certain, tariffs will have only a small and short-lived effect on inflation going forward. And for all of you people who are Princeton class of 2010, short-lived. A surge in high-tech investment, likely related to interest rate insensitive AI and data center projects, accounted for at least half of the increased demand in the first half of the 6 months. They're talking about GDP growth slowed to a modest pace and pointing out to this type of investment accounting for half of the increased demand in the first 6 months. We got the GDP report this last week and it showed stronger Q2 than expected. But we had weaker Q1. So you have to look at the first 6 months by taking the ending GDP divided by the beginning GDP, square it, subtract 1, you'll get a growth rate. It's like 1.5%. And if this accounted for half, you're talking about without this type of investment, some would argue massive overinvestment, by the way, without this type of investment, you're running less than 1% annualized. You will hear planes behind me. You will hear birds behind me. It is a occupational hazard of living in paradise. Declines in housing activity, including single-family home construction and sales, have been accompanied by higher inventories of homes for sale and falling house prices, suggesting that housing demand has also weakened. We see this in National Association of Home Builders Sentiment Index, under 50 for a long time at 32. We're also going to do a brief highlight of Lennar's earnings. Given very low housing affordability, existing home sales have remained depressed since 2023 and at levels only comparable with the early 2010s following the financial crisis. I'm concerned that in the current environment, declines in house prices could accelerate, posing downside risks to housing valuations, construction, and inflation. The majority of Americans have most of their retirement savings tied up in their home. You can imagine if that starts sliding 5%, 10%, 15%. It's kind of rare in a situation like this, but sort of putting that specter up there that this is a retirement fund for most people. Labor market down sharply from the moderate pace of job gains seen earlier in the year and well below estimates of break-even rates due to softening in labor demand. Although still near full employment, labor market has become more fragile, could deteriorate more significantly in the coming months. Unemployment rate has increased notably among groups that tend to be more affected by the business cycle, including teenagers. And the employment to population ratio has dropped significantly this year, showing more softening than the unemployment rate implies. Layoffs have edged up from low levels and could rise quickly if the economy weakens further, since hiring rates have remained low. We get a lot of jobs data this week, including the Challenger report that talks about the amount of layoffs. One consequence of a less dynamic labor market this year is the significant increase in the number of long-term unemployed workers. Every week we get initial claims, hover around 220, but if you look at the continuing claims, hovering just below 2 million. Payroll employment growth concentrated in just a few service industries that tend to be less affected by the business cycle: healthcare, social services, leisure, and hospitality. More than accounting for all the job gains since April. If you listen to this every week, you know that I've been making that point for some time, that if you control or take out the healthcare jobs, this economy has not been producing any jobs or very few jobs. Share of industries with positive job growth over the last 6 months dropped below 50% in August to a historically low level. That means the share of industries with not job growth, but that are shrinking, negative job growth, are over 50%. Actual payroll employment may have started to fall in recent months. This is saying that never mind flat jobs, but there probably is in behind these numbers negative job growth, given the sizable upward bias in the published data implied by the Q1 quarterly census of employment and wages. On price stability, we have seen some progress in lowering inflation, excluding one-off tariff effects on good prices. Based on the latest consumer and producer price reports, 12-month core PCE inflation likely stood at 2.9% in August. And if you were watching the PCE report, every number came in exactly as expected, which usually is the case with PCE. Once we have CPI and PPI, you can calculate, based on the weightings in PPI or PCE, what the PCE will be. So it's very rare that it really differs a lot from expectations. Came in right on the numbers. However, after removing estimated tariff effects, core PCE inflation has hovered around 2.5% in recent months, which is significant progress and within range of our target. If demand conditions do not improve, businesses may need to begin to lay off workers, recognizing that it will not be as difficult to rehire given the shift in labor market conditions. On trade policy, foreign suppliers are absorbing some of the new tariffs. Importers are shifting to lower tariffed sources. Slack in the economy should allow for only limited one-time price effects this year and very little, if any, second-round effects on inflation in the medium term. We're going to see that Nike is doing this. We're going to do a little profile on Nike. They are shifting some of their shoe production out of China to lower tariffed regimes. They are implementing strategic price increases on premium products, which will tend to have a lower weighting in CPI and PCE. So even though you're getting some of the price increases, companies are being very strategic in where they're putting the price increases, and they're putting it on the premium products because buyers there are more quality sensitive and less price sensitive. And those products will have lower weightings in the basket of consumer goods. In my view, the recent data, including the estimated payroll and employment benchmark revisions, show that we are at serious risk, not risk, look at that, serious risk of already being behind the curve in addressing deteriorating labor market conditions. Should these conditions continue, I am concerned that we will need to adjust policy at a faster pace and to a larger degree going forward. The U.S. economy has experienced aspects of a negative supply shock from higher tariffs that is also affecting aggregate demand. Since these conditions are unlikely to lead to persistent effects on inflation, and because changes in monetary policy take time to work their way through the economy, optimal policy calls for looking through temporarily elevated inflation readings. Therefore, we should proactively remove some policy restraint on aggregate demand to avoid damage to the labor market and a further weakening in the economy. I put this in purple because this is, I think, the second time. Powell mentioned AI once very briefly. This is the second time there is a head nod towards this stuff. In addition, putting tariffs aside, the U.S. economy may also be experiencing an extended productivity surge in large part because of recent technological advances. Name it without naming it, right? And productivity growth has likely been higher than reported due to downward benchmark revisions to payroll gains. In my view, it was appropriate to begin the process of moving policy towards a more neutral stance at this meeting. And it has been for several months. In thinking about the path forward, I supported revising the characterization of the policy outlook in the post-meeting statement. It is important we signal that last week's actions include a forward-looking view of additional adjustments. If the statement had not included a reference to additional cuts, it would have signaled to markets that the committee would not be responsive to weakening labor market conditions. We're almost done here. This is it, just these two. Cutting the policy rate by 25 basis points and signaling additional adjustments at upcoming meetings should allow longer-term interest rates to remain materially lower than earlier this year. We are not materially lower than earlier this year. And when we go out to the 20 and the 30, I think she's probably talking about the 10, the 5 and the 10. Finally, I should note that the rising downside risks to employment and the potential for greater damage to the labor market underscore the need to shift our focus away from overemphasizing the latest data points. Finally, somebody saying it. Let's stop being backwards looking. A strict interpretation of data dependence is inherently backward looking and would guarantee that we remain behind the curve, requiring us to overcorrect in the future. I think we should consider reframing our focus from overweighting the latest data to a proactive, forward-looking approach and a forecast that reflects how the economy is likely to evolve going forward. I don't know that she's speaking for Trump, as Miran did, but she has had this view for a while, and I think she's right. The policy should have been cut in July. More attention should be paid to the future instead of the past. And please, let's start thinking that, how you're going to incorporate AI into your forecasts, or you will be behind the curve. It is refreshing to at least see a head nod in that direction, if it not naming it, but, it's quite clear, I think, what she's talking about. Let's have a look at how rates and yields ended the week. Rates up to the 6-month, all well behaved and within range. The 1 year beginning to price out cuts. Capital market curve rising yet again. If we look at where the 30-year is in relation to the beginning of the year, it is down 1 basis point. The 20-year is only down 12. The 10-year, that is down 38. I think that's what Bowman was referring to, is that their policy action should keep the long end of the curve down. Let's see if the capital market gets that memo. October 29th, FOMC is now 31 days away. We have a whole slew of earnings to get through before then. We have one more jobs report. We'll have another CPI report. Don't think we'll have another PCE report. No, we won't. The PCE report will be the Friday. They're on the Wednesday, on the 29th. Big jobs. Oh, sorry, I was going to jump over our probabilities here. Zero, no cut. Went from 8% to 10%. I don't know how you're getting that. And 25 basis points was almost 92%, now 89%. Again, I think that's wrong. I think we have a 100% probability of another cut in October. Jolts we get in 2 days. This is for August, a little backwards looking. ADP in 3 days. How many out there, show of hands, think that this is becoming the more important number, the more reliable number to look at? It doesn't have any government jobs in there, though. Initial claims in 4 days. Pay attention to continuing claims. We're at 1.92 million. And our jobs data in 5 days. That is the big boy on the street this week. We do have a few earnings this week, but I don't think it's going to be as important as that jobs number is going to be. ISM manufacturing in 3 days. ISM services in 5 days. This is for September. Manufacturing doesn't really move the market that much anymore, but services still has that ability. And we do have some Fed speak this week, Williams being the important one. Bostic is not on board with the rate cuts, but he is not a voting member and he's not a governor. He's just a Fed president, but he better watch himself. He'll be out of a job in February. The curve, 2 to the 10s, upward sloping 57 basis points. A 3-month to the 10-year, upward sloping 18 basis points as that money market curve. This is the 3-month is the money market, the 10-year is the capital market. As the money market, capital market curve gets steeper and steeper, banks do better and better. So if you are thinking there'll be continual rate cuts, you want to be in banking, and the cleanest banking book you can get, that would be the regional banks. I will talk about the stable coin here in a little minute. GDP, January 21st to June 30th, the first 6 months. You take the ending GDP divided by the ending GDP of Q4. Since it's for 6 months, you square it to make a year, subtract out 1.57% GDP growth. So even though you had a strong second quarter, it was a bounce back from a weak first quarter, especially in key categories. So if you look at it over the 6 months, not that great, 1.57. And Michelle Bowman in her speech was pointing out that just the investment in data center capacity alone accounts for about half of that, 0.8. So GDP, real GDP for the first, for annualized for the first 6 months is under 1%. That is rather weak. TLT had a week over week, down 0.13. SPX down 0.31. The dollar index poking its head above water here for a breath, 0.52. Let's have a look at where ZQ, ZQ is effective federal funds rate is now 4.08. Q4 pricing in 40 basis points of cuts. I think that's probably 50 for sure. You're going to get 2 there, so let's write in a 50. Q1 pricing at 18.5. I think you have a 25 in there. And by the end of Q2, another 19.5. I'm going to give Powell 25 on that one, and I think you have 100 right there. And then you have 3 meetings ex Powell. I think you go 50, 50, and 50. If in a perfect irrational Trump Fed, you go 50, 50, 50. So you could be looking up to 250 basis points of cuts between now and then. Yeah, I'm going to say that that's probably aggressive. I'm looking for 200 by that point in time. We're looking at 93 basis points, 3.5 cuts. I think that is way under where we're going to be. 4 in 8 meetings, and 3 of those 8 are ex-Powell. I now have 347 contracts on the October 2026 ZQ. This is pricing in an ending rate of 3.15, less than 4 cuts to go. If there are only 4 cuts, if we only get 4 cuts, my average price here is 96,966. 4 cuts is 96.92. I would be giving back 4.6 basis points. I'd be down 66,000 on that. We get 5 cuts, I'm up 295,000. We get 6 cuts, I'm up 656,000. I want 500. So we are at a fairly low rate, 96.85. But if I go out to December, which includes 2 more Fed meetings, if I go out to December, I'm only paying about another 4 to 5 basis points. It's 96.89 to 96.90, which then gives me 2 more meetings, and I'm only giving up another. And we're still by the time you get there, still below 96.92, saying that by the end of next year you're not even going to get 4 cuts. That's 10 meetings, and you're not going to get 4, and 5 of those are ex-Powell. Come on, tell me I'm wrong. So probably going to add the other 153 by going to the December contracts. Okay, let's have a look at stablecoin. I asked Perplexity for its best estimate as to where the value of it would be as of September 2025. 293 billion, which represents about 1% of outstanding U.S. debt. Debt's much higher, but the Fed is holding about 6.2 of that, and Social Security is holding a bunch. So once you account for what the government is basically owing itself, you get to about 30 trillion. So 293 billion represents about 1% of that, and this has slowly been increasing. I think there is value in the use of stablecoin in terms of being able to transfer money across borders very, very quickly. This is, I think, is probably only going to increase as its usage and adoption increases, and the Treasury has been favoring money market issuance at this point. So if you can imagine a situation where you can get that short rate to come down, these holders don't disappear, and as stablecoin adoption grows, those holders must continue to buy the T-bill. So you can imagine a situation where why pay them anything? If you went all the way to 0, you wouldn't have to worry about who would hold the T-bill. They have to hold it. You'd also begin to squeeze a lot of that money. There's over $7 trillion in money market funds. You'd also begin to squeeze some of it into the longer end of the curve, or at least somewhere else other than money market funds. So let's not forget about that as a tailwind. Having a look at real yields, all of them have increased. Our break-even rates, nothing going on here. Basically flat, along with OAS, basically flat, so nothing much to talk about there. Mortgage rates pushing from 6.26 to 6.3, up 4 basis points week over week. We do have some housing data this week. Pending home sales for August is on Monday. This is not really a big deal. House price index, along with Case-Shiller, for the month of July. This is really backwards looking. We get that on Tuesday. Last week, coming off, if we looked at mortgage apps last week for the week before, really big jump. This week up 0.6. New home sales, though, big jump, up 20.5%. That's month over month, by the way, and existing home sales down 0.2. Let's take a moment, look at Lennar. Lennar came out not this past week, but the week before. But it does match something that Bowman had talked about, talking about housing sales being depressed, the lowest level since 2010. And with Lennar, we see their incentives at the highest level since 2009, sort of backing up that idea that houses are becoming harder and harder to move. So let's look at Q3 2025 versus Q3 2024. EPS, they reported 229. The year before was 426. That's a big step down. Adjusted EPS $2 versus 390. Revenues were 800 million lower, 8.2 billion versus 9 billion. And the argument here is it largely reflects a 9% drop in average selling price, which was 383 instead of 422. That does not mean that they're building a house that they could sell for 422, and now they say, well, we can only get 383 for it. It means that they're building a house, instead of looking like this, it'll look there. We'll just take this off the side of the house. It's just a smaller house. So they build to a selling price, as opposed to having a model and saying, well, we can only get 383 now. Last year we can get 422 for the same thing. They're just building smaller houses, but also increasing the amount of incentives they use. 14.3% of the final sales price. Highest since 2009. That gives you an idea. Like 2009, you couldn't sell anything. That gives you an idea of how hard it is, what an environment they have for selling houses. That's why we see the NAHB, National Association of Home Builders, their sentiment index sitting at 32. That is a diffusion index. Anything below 50 is contraction. Operating margins took a big hit, 9.2% for the quarter versus 16% the year before. Here's the bright spot. New orders up 12% to 23,000 homes. Maybe suggesting that the trough is behind them, the worst part is behind them, and maybe they're starting the climb out of that hole. Deliveries in Q3, 21,854. In Q3 of last year, 21,516. So basically flat. You had slightly higher deliveries, resulting in lower revenue because of your average selling price, the contraction of your margins. On top of that, really hit your EPS from 426 down to 229. Okay, let's talk about Freeport and copper prices. This week, Freeport gave an update to the mudslide it had in Indonesia at the Grasberg mine. They had initially reported September 8th. They gave an update, and the update was a little worse than what the market expected. They did recover 2 of the miners. 5 are still missing. It is now called a recovery effort as opposed to rescue. 800,000 metric ton mudslide. Their Q3 guidance, their sales will be 4% lower on copper, 6% lower on gold. Q4 sales from Freeport, insignificant. The mine that it went into has 5 sections. It's a block cave mine with 5 sections. 1 is the affected, but it has affected the other 4. They believe that starting in 2026, they should be able to bring the sections back online over time, that by the time they get to 2027, they will be back at regular production levels. So they're not offline until 2027. Q4 is a write-off for that particular block cave mine, all 5 of them. And starting in 2026, they'll start to bring it back online, but they are guiding 2026 production to be 35% lower. Previous guidance was for 1.7 billion pounds of copper, 1.6 million ounces of gold, and they expect to be 35% lower, back to that production by 2027. They do have insurance. They said that they are going to seek a refund or a payment out of their insurance up to $1 billion. Their hit to EBITDA is estimated to be about $3.5 billion over that period of time. They were expecting $12.5 billion in EBITDA. That would bring them down to $9 billion and potentially a $1 billion payout. But these things take time for those types of payouts. So copper really responded. Here is Freeport's price action from a little over $45. We're down to $36. Roughly about 20% of its price is gone. But this mine offline, this represented 3% of the world's copper supply. So have a look at what happened to copper. It just jumped. I had already in place a December-March flattener based primarily on inventories and inventories coming down and on interest rates coming down. And I had the 440 and 430 puts. So when we got to about here, the 440s, 430s were not really worth holding anymore. I think $0.015 was all that was left in them, so I closed them. I still have the December-March flattener. I am long 3,000 shares of Freeport, average price 39, and I have 2,000 more shares associated with puts because I have 20 puts. If they're all put to me, my average price will be right around $39. We're sitting at $36 right now, so that is underwater. Citi is estimating the long-term impact is about 3% on Freeport's price, but we have a 20% adjustment. It is, I think, massively overdone. This is not a situation where it's a hotel where that revenue is lost forever. That copper still lives in the ground. So it just means that copper that is not taken out in 2026 just gets added to the end of the mine's useful life. It just extends the useful life an extra year. So that copper just is further dated in the future. And maybe it turns out to be a good thing for Freeport, because if you can't take that out of the ground at about $4.50 to $4.75 an ounce, by the time you get to 2027, just the sheer increase in the amount of energy this world needs to support all that data center build out, they may say, well, we couldn't get it out at $4.50, $4.75. We're now getting out at $5.50 to $5.75. So maybe this forced savings allows them to cash in that copper, in 2027 at a higher price. I think that's worth considering. Bernstein upgraded Freeport to a buy based on this price here, not based on the news, but based on the news and the fact that it dropped 20%. Well, that's a buy now. Citi has a hold. All the price targets I've seen, price targets have been lowered across the board. Roughly by $2 to $4. No one's lowering their price target $20, $30. They are lowering their price target because, again, if you think about a time frame, and this is the year in which you were going to get the copper out, this is the end of life of mine. If you're not going to get it out here, the end of life of mine just increases, so this copper comes out over here. So yes, it does have a net present value effect because that copper is more longer term dated, but I think it'll come out of the ground at a higher average price than what it would be through 2026. So I am holding this one. I don't mind this one. It has good options, so I can sell some upside calls. I'm getting the dividend. I think it probably would be in their interest to suspend the dividend for 4 quarters. I don't know if they'll do that. I think it would be in their best interest to do that, but that may be a step too far. The dividend it's not as if the hit to cash flow would affect the dividend. I just think that at this point in time, conserve the cash would make more sense to me. I am long this. I'm probably going to sell upside calls. I do expect that we will fight our way at some point back to 40. I'll probably be looking to sell calls at around 40 for about half of what I have. And if we keep paying the dividend, I'll just collect the dividend. Let's have a look at Costco. We had earnings last week. We'll just go through the highlights here. They sold off. They were in the 940s, 942. Before earnings. They did have a run up, and then they came down. By next day they were selling off, ended at about 917. Some people pointing out valuation. I'm going to show you valuation is not a big deal. Let's start with EPS, 587 versus 529. This is for the quarter, the fourth quarter. Their quarter ends at the end of August, so they're reporting the end of fiscal year 2025. 587 versus 520, up 11%. Revenues, 86.16 billion versus 79, up 8.1%. This is in line with what in our financial modeling for Costco, what we were modeling. Not exactly, but we're right in that neighborhood. For the full year, revenues 275 billion, EPS of $18.10. Membership fees up 14%. Stores in 2025, they opened 27. They tried, their target is 30 per year. They opened 27. 2026, they have a target of 35 stores. As far as tariffs, they're saying they're going to shift anything that is coming in that's tariff. They're going to shift it to a Kirkland product if they can. Better margin on the Kirkland product. This is probably where the sell-off is focused on. Same-store sales up 6.4%. That is ex-gas and Forex. That is now the second quarter of declining same-store sales growth. Not declining same-store sales, but just the declining growth rate in same-store sales. U.S. 6%. There's your problem center. Canada 8.3, international 7.2. U.S. is becoming the issue. Traffic up 3.7%. Average ticket up 1.9 on an adjusted basis, up 2.6. The multiplication of these two get you to your 6.4. Overall, right in line and a little bit better than expectations. This is a solid business. You have three businesses in here. You have a merchandise business which tends to have a margin of about 2%, about 200 basis points, really low. But a negative cash conversion cycle because they sell their product faster than they pay their suppliers, and they pay their suppliers usually net 30. And they're very good at that, way better than Walmart. But they sell their product faster, which means their working capital doesn't have to be financed. No working capital in that respect because of the negative cash conversion cycle. You have another business in there, which is a growing perpetuity. So think of the membership fees as a perpetuity. Every 5 years they raise that price. And their retention rate, their loyalty, 92% renew on their membership. 92%. So you have a growing perpetuity is the second business. And number three, you have a real estate business. And that is the underappreciated part of Costco. They have a market cap of $406.2 billion. So if you take their earnings with their market cap, you get to 47 times forward earnings on Costco. And that's where people are saying, yeah, okay, it's a growing perpetuity, and people love it. But 47 times forward earnings, I'm going to show you that it is not 47 times forward earnings. They report under U.S. GAAP, which means they use historical cost reporting. Property, plant, and equipment is $31.9 billion. On there is a whole bunch of property in California, because that's where they started, that pretty much is being carried on the books at zero. Does that sound right to you? Now what they do, let's just draw out a city. We'll draw out a city and say Costco wants to set up a store. They don't buy real estate in the middle of the city. They go out to the edge of the city and they'll buy real estate over here. And they'll build a Costco way over here. Wherever they build a Costco, other stores start to show up around there, and then a neighborhood will show up here and a neighborhood will show up here. By the time you get this kind of urban creep, it pushes up the value of the property they bought. So they buy outside, just on the edges of a city where property prices are low, and then cities end up moving and building up around that area, pushing up the value of their property. So if we just take a conservative approach and say, well, what does it cost them to build out a new property? And this is, of course, buying it at that lower price, $203 million. If we just take their CapEx divided by their number of store openings, you get to about $203 million. If you multiply that $203 million by what they own, because some places they don't own the land, some places they don't own the building, but if you multiply by all the stores they actually own, you get to about $180 billion conservatively. Now, I'm not including what the price of the property would be now that the neighborhood is built up around the Costco. This is $203 billion, assuming they can get that land on the outside of the city at that cheap price. If they had to go to where existing Costco's were and attempt to buy the land, yeah, they'd be much higher than $203 billion. So let's say it's $180 billion. They're carrying 32 of that in PPE. So let's take $148 billion off the market cap, because it simply doesn't exist. You get to $258.2 billion. And if you divide that by its original amount, just to show a percent, basically 63.56. 258 is 63% of that. So take 63% of the forward earnings, you get to 29.9 times forward earnings for a growing perpetuity with a real estate portfolio that grows over time. Let's have a look at SPY. Last week we hit all-time highs again. September 22nd, we got 66671. Let's not pay attention to the 666 though. That doesn't mean anything. And on QQQ, 60224. Also hit on September 22nd. Small caps not coming along for the celebration. No new all-time highs there. Our forward four-quarter operating earnings, I think this is the first time in 4 weeks or 5 weeks it's actually dropped. 283.19 down from 284.20. SPX at 66.43. Leaves the forward multiple unchanged, 23.46. Implied volatility also rather unchanged. 13-week is sitting at the 34th percentile. Last week was the 35th percentile. So not much to see here. Just one long upward sloping support line on this one. I don't anticipate, based on what we've seen on the data, barring, of course, any exogenous event, I don't see why this market wouldn't continue on the same trajectory into the end of the year at least. We do have earnings this week. Nothing really exciting, but a couple interesting ones. They both agree. Look at that. They both agree. I didn't check the dates. I just thought, give me a victory where I can get a victory. Monday, we have Carnival. I find that one interesting. Tuesday, we have Lamb Weston and Paychex. And Wednesday, we have ConAgra Brands and Nike. I'm going to do an earnings vol play on all of them, but not Carnival. I do have long positions in both Paychex and Nike. Nothing in ConAgra. I have played Lamb Weston before. Just for preview, let's look at Nike and see what it is that we should be looking at when they report. Okay, let's have a look at Nike. I've got a 1-year chart up. We have the Q1 earnings approaching. Expected EPS 26 cents per share. That would be down 63% year over year. And expected revenue 10.99 billion. That would be down 5% year over year. They had previously reported that they were looking at about $1 billion in tariff costs. 16% of their footwear is from China. They are hoping to drop that to less than 10% by the end of the fiscal year, which is end of May 2026. Looking for some offsets for the tariffs. The big one here is sourcing shifts moving out of China, looking at Vietnam and Indonesia. Partner deals, and this is upstream partner deals, leaning on them and seeing if they can absorb some of the costs. Cost cuts, internal cost cuts, and targeted price increases. This is in the U.S. beginning in the fall of 2025, and they're really focusing on premium brands that they can pass on along some of these costs. They have previously reported for China revenues, Q3 were down 17% year over year, Q4 down 20% year over year over the Q4 of the previous year, and digital sales down 20% in Q4 year over year. So they do have their challenges here in China, their challenges in the digital space, and their challenges in terms of the tariff costs. So let's see what we would be looking for when they report. Number one, gross margins. They have guided gross margins to be down 100 basis points year over year for Q1. Any beating on that would be good. For all of 2026, they're guiding to be lower by 75 basis points. By focusing their price increases only on premium models, it is hoped that they can preserve gross margins by getting the extra revenue there. So let's watch that. Chinese market stabilization. You can't keep having these big declines year over year. Digital sales trajectory. Let's watch that number here and all of guidance for 2026. Their price performance after earnings doesn't have a very good track record. 63% post earnings, their price drops. The median drop is about 6.5%. So if you're playing odds, you'd more than likely sell calls on Nike. However, a lot of this bad news is already known. And the one important thing that I always stress is it's okay for a company to have problems. As long as management recognizes that it has a problem, you're on your way to a solution. The big problem with a company is when management does not recognize that it has a problem. Here they do. If we look at the October 3rd $70 straddle, because they're sitting at $69.25, and it's way too early to be pricing out the straddle. For an earnings play, you're really putting your position on about 10 minutes before the market closes. But if we just priced it out now, the 70 straddle for October 3rd is at $5.95. That's 8.5% implied move. And the median is 6.5 and it's 8.5. I would expect that as we go into earnings, this probably would increase to 9 to 9.5, maybe even 10%. That's if it's only 6.5, I don't know that I'm willing to sit under the put wing. But if it is pushing up at 9, 9.5, 10%, then yeah, I will go to the wing, and then I will sit under the wing and sell some puts on that one. So there are 4 good opportunities this week for earnings vol plays. And then you have your big macro risk backdrop, which is the jobs report on Friday. And I'll see if I can pick up some ZQ on the December 2026 contract. I'd like to see it pull back a bit, although every point it pulls back is just painful at this point. I would like to see it pull back a bit so I can get some of the December ZQ before the Friday's job report. And that is all I have for you today.